How to maximize your retirement savings by going beyond traditional retirement plans. If you're a high earner, there's a good chance that your retirement accounts that are qualified aren't going to be enough to maintain your lifestyle in retirement. Contribution limits cap how much you can set aside, and taxes can take a serious chunk out of what you save. That's where the Non-Qualified Deferred Compensation Plans, or NQDCs, come in. They're a powerful way to save more and design a retirement income strategy that works for you and your lifestyle. Today, we're going to break down exactly how these plans work, why companies offer them, and the 2 key decisions you absolutely need to get right if you want to use them effectively. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. An NQDC plan is basically an agreement between you and your employer where you agree to delay part of your income until a future date, usually retirement, or when you leave the company. Companies typically offer these plans for 3 main reasons. The first is the wage replacement ratio. For high earners, you can only contribute so much to your 401k plan, so when you get to retirement, you might not have enough to sustain your lifestyle through the duration of your life with what's in that qualified plan. The NQDC allows you to bridge that gap, having more money in a tax-deferred bucket than you would if you were only contributing to a 401k along the way. The second is to let executives defer income and taxes. If you're in your highest earning years right now, you might be in the top marginal bracket. So, by deferring some of your income to a time when you're earning less, like in retirement, you could save a huge amount in taxes. While the second reason is good to incentivize new talent to come to a company, executives, that sort of thing, the third is about retaining those executives. When an executive has a bunch of money in a non-qualified deferred comp plan that requires a certain amount of years of service to vest, they might stick around at that company longer than if they had money that they could roll out into a different plan or an IRA at a different company. So that's why companies offer them, but let's talk about how you can maximize these plans. Joining the plan is really just the first step. The real impact will come from these 2 decisions. The first, how you invest the money along the way, meaning your investment allocation. And the second, how and when you take it out, meaning your distribution election. Let's first look at the investment allocation. When you participate in an NQDC plan, you'll be given a list of different investment options, kind of like your 401k. This often includes mutual funds or preset portfolios from a third-party allocator or custodian. You then decide how you want to split your contributions among these options based upon your time horizon, risk tolerance, and financial goals. Now, this is where NQDCs are different from traditional retirement accounts. In a 401k, your money can sit there and grow until you start having to make qualified withdrawals. With an NQDC, on the other hand, you don't have that same kind of flexibility. Your funds will be distributed after what's called a triggering event. It's usually retirement or when you leave the company. This means that your time horizon for growing investments could be much shorter than you think. And that changes how you might think about allocating these funds along the way. If you're going to need the money soon after leaving, maybe to bridge the gap between when you leave and when your pension kicks in, or you start saving or start drawing from Social Security, you'll want to choose a more conservative allocation that'll protect your assets against market volatility. All of this, of course, depends on when you start these contributions. If you're 60 years old and you have 5 years to retirement, that might be a more conservative allocation than someone that's 45 starting their contributions into the NQDC, and they need something a little bit more in line with the rest of their retirement assets. And so if you have other sources of income that'll cover your needs for several years after that triggering event, maybe you get another job or start consulting, whatever it may be, you might want to choose a more aggressive allocation that's more focused on maximizing that long-term growth. This is where having a detailed financial plan will help you map out your future cash flow needs and determine how much risk you can take within your portfolio. Also, by actively managing and rebalancing this account, you can turn this deferred income into a powerful tool for building real, long-lasting wealth. Let's now look at the second decision, how to distribute these funds. Unlike qualified retirement plans, NQDCs don't have any age restrictions on distributions or any required minimum distributions. However, you will have to decide in advance how you want your deferred income to be paid out. Typically, you'll have 2 choices, either a lump sum payment or installments paid over different time periods. You can generally make this decision on an annual basis and change how you want those distributions coming out depending on how your financial plan changes or your lifestyle adjusts. In the case of the lump sum, you'll receive the entire balance in one payment, at least the balance from that year in which you elected those contributions, once the trigger event hits. There are three main advantages to taking this lump sum option over the installment time schedule. The first is immediate access. Say you need a large amount of cash, maybe to buy a vacation home, invest in a new business, or fund a big life goal. The lump sum gives you access to all the money at once. The second is that it gives you more investment control. As I mentioned, NQDC plans often have limited options to invest in, mostly just mutual funds and some preset portfolios. But by taking the lump sum, you can move that money into one of your own accounts, investing in a broader range of investment options like mutual funds, ETFs, even individual stocks if you want to, or alternatives like private debt or private equity. The third advantage to the lump sum is that it eliminates company-specific risk. Remember, non-qualified deferred comp plans are non-qualified, so they don't have the same protection as, say, a 401k plan. It's essentially an IOU from your company. So, if the company goes bankrupt, your funds might be at risk. A lump sum distribution removes that risk by getting your money out of the company's hands and under your control. However, there are also some trade-offs that you should be aware of when taking the lump sum. And the main one is that you'll owe taxes on the entire sum in the year in which you receive it. This can push you into a higher tax bracket for that year, and you'll lose the benefit of that tax-deferred growth once the funds leave the plan. Let's make this a bit clearer with an example. Say you take a $1 million lump sum distribution. If you're a married couple filing jointly with no other income, you'll owe over $280,000 in federal taxes in the year in which you receive it. You can also choose to take distributions in installments. This breaks out your payout into smaller, equal payments over several years that are typically distributed monthly, quarterly, or annually. There are two key advantages for this option, and those are huge. The first is that by spreading out your deferred income over time, you also spread out your federal tax liability and reduce the risk of jumping into a higher tax bracket along the way. You might also benefit from an exception when it comes to your state taxes if your installments are paid over 10 years or more. In this case, payments are taxed in your state of residence at the time that they're being paid out, not in the state in which the income was earned. That means that if you were to move to a state with no income tax, you could legally avoid state taxes on those payments in addition to already lowering your annual federal tax liability. The second advantage is that ongoing tax-deferred growth. By getting paid in installments, the portion of your non-qualified deferred comp account that hasn't been paid out will stay invested and continue to grow without being taxed until it's distributed. This growth compounded over time can be a really powerful way to accumulate wealth. Let's look at an example of a 15-year installment distribution. In this scenario, the same $1 million is paid out, but in equal installments of $66,666 per year for 15 years. As you can see, your federal annual tax bill, if you're a married couple filing jointly, is $7,500 for a total of $112,000 over the course of those years. Now, compare that with the lump sum distribution, and you're saving over $170,000 in federal taxes just by choosing a different payout schedule. Obviously, this example is basically in a vacuum. We're not considering other income streams like Social Security, pensions, or anything else going on in one's life, like investment income. So it is a very simplified example, but it gives you an idea as to the difference between the tax implications of the lump sum versus the annual payout. And in practice, as advisors, we find that the lump sum payout is very rarely the best option for clients because of that big tax hit. Generally, spreading those distributions out over the course of time, maybe even longer than a decade, can be generally the best thing for a client. Ultimately, before making any decisions, it's crucial to have a comprehensive financial plan in place that projects your income and expenses into retirement, models different payout scenarios, factors in your future state of residence, and weighs your tolerance for risk. This will give you the peace of mind of knowing that you're making the right decision for your money and your future. Let's end with a few key takeaways. 1. NQDC plans can be a powerful tool for high earners. They let you save beyond qualified plan limits and defer taxes. But it's important to remember that they require careful strategy. 2. How you choose to allocate and distribute your funds will have the biggest impact on your portfolio. Your choice of allocation should reflect your future cash flow needs, while your distribution schedule will directly impact your taxes, investment growth, and exposure to company risk. 3. Company solvency shouldn't be ignored. NQDC funds are not protected like qualified plans. They are unsecured funds, so if the company struggles financially, your balance could be at risk. 4. Have a comprehensive financial plan that turns this simple tool into a strategy for building wealth. The right modeling can show you exactly how your non-qualified deferred comp plan integrates with your 401k, pension, and Social Security. as well as help you avoid costly tax and cash flow surprises and investment mistakes. Before committing, work with an experienced financial and tax professional to run the numbers, stress test different scenarios, and understand the legal and tax consequences. With our clients at Pacific Wealth Management, we find that no one-size-fits-all option is generally the best call for a non-qualified deferred comp plan. The only way to really figure it out is to run specific projections based upon that client's life and understand the taxable implications of choosing X versus Y versus Z in different scenarios. This is critically important to finding the right solution for your goals and your needs. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, be sure to visit us at www.pacwealth.com. Thanks.